Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, as always, Michael Becker.
Hey, Paul.
In the podcast today, I think we're going to talk a little bit about strategy. And strategy is CPA, taxes, accounting, and maybe some of the reasons why people actually invest in real estate. It's just not because they want to, that there's a rate of return on it, but there's some types of tax advantages. And we want to kind of take a super complex thinking of accounting and try to bring it down to just conversational. So make sure everybody understands about why we invest in real estate and some of the tax advantages that real estate brings to us. So I think it's going to be an interesting conversation. We're going to have two CPAs, and I want to kind of introduce them, and then they'll talk a little bit about what their background is and talk a little bit about just some general knowledge. I'm going to kick it over to Mike for some questions, but just kind of kicking it off right now, I want to introduce Mark. Mark, how are you?
I'm doing great. How are you, Paul?
Good. Mandy, how are you?
Doing well, thank you.
Good. I'm glad that you guys were able to come into the podcast today. So now I'm going to kick it over to Mike, and let's get going.
Yeah, Mark, maybe just kind of give a little background on your firm and you two, and kind of tell us a little bit about kind of what you guys do.
Great. Thank you, Michael. We're a CPA firm here in Dallas called Patten, and we deal with our client base typically is owner-entrepreneur businesses. So we deal with owners and their businesses. Those businesses tend to be $1 million to $100 million of revenue. Our clients also are high net worth individuals and busy executives, and we focus in different industries, including oil and gas, real estate, private equity, and high tech. And the type of work we do is typically tax structuring and tax planning, which leads to tax preparation. So we focus on taxes. We also do a lot of what I would call outsourced CFO type work for our owner businesses, including M&A deals. We help with buying and selling of businesses. We help with various transactions that owners go through. We also do a lot of trust and estate work. We also do financial planning as well.
How long have you been a CPA?
I've been a CPA since 1985.
A long time.
A long time, yeah.
Mandy, how long have you been a CPA?
I've been a CPA since 2012, but in the industry since probably 1998.
Okay, so a long time. So,
yes.
So this conversation today, we're kind of focusing on real estate.
Yeah, so maybe just kind of start, Mandy, talk about the various sources of income that people have, kind of start at real high level, kind of the earned income, passive income, et cetera.
Sure. So earned income would be your W-2 wages or income from self-employment activities, which would be a sole proprietor, or income from a general partnership. Anything really that's subject to Social Security tax, you can think of as earned income. That's taxed at your ordinary income tax rates, which we all know depends upon our unique situations. Then there's portfolio income, which would include your interest income, dividend income, as well as your capital gains and losses. So your interest and ordinary dividends are going to be taxed at your ordinary tax rate, whereas qualified dividends and your capital gains, that is long-term capital gains, would be taxed at the capital gains tax rate, which could be 0 to 15%, depending on your income level. And if you're higher income level, you should expect about 20% there. Then another way to think about income is passive versus non-passive income. So passive income is going to be income generated from a trade or business in which you don't have material participation. Also, always considered passive income is rental real estate activity. Then moving on to non-passive income would be your trade or business activity in which you materially participate, and there are some tests that you can go through to identify material participation.
So like business owner, kind of a sole practitioner type of thing, that would be, if you organize an LLC, you own a business, you operate it, that is active income, not passive. if you just invest in someone else's real estate syndication, for example, that's most likely a passive income?
Correct.
Okay. And then, so one of the things that some people may or may not have heard of is as a real estate professional. So maybe, Mark, you talk about what is a real estate professional for the IRS designation, and what is it kind of basically, what are the advantages of it, and then what does it take to qualify as a real estate professional?
So, as Mandy mentioned, real estate income or income from real estate activities is considered by the IRS per se passive. And the downside of that for a real estate investor is that a real estate investor, if they're passive, are unable to take the losses from real estate activities and offset those losses against non-passive income. And then secondly, real estate income is considered net investment income. It's subject to a 3.8% surcharge on top of ordinary income tax rates. So Congress, about 20 years ago, created an exception for real estate professionals, which allows real estate professionals to treat a rental real estate activity as active. And that's a good thing, so that if you have an apartment complex and the apartment complex throws off losses due to, say, depreciation, and you're a real estate professional, typically you can take those losses to offset your W-2 income, for example. And so then the question is, what is a real estate professional? So, and these are all complex facts and circumstances type classifications, but generally speaking, a real estate professional is someone who devotes greater than 50% of their personal service activity during a year in a real estate trade or business. So if you're a real estate broker, for example, and you do that full time, you would qualify the first test as real estate professional. The second test is that you materially participate in the investments that you own, and you materially participate in up to 750 or in excess of 750 hours per year in the individual investments.
So if I have a full-time job, can I most likely be considered a real estate professional if I have a real like a straight job, a W-2 job?
If your straight job is not in the real estate trader business, the answer is no. So if you're a lawyer and you work 2,500 hours a year as a lawyer, then you'll fail the first test. But if you're a real estate broker, you're a real estate mortgage lender, you are a builder, lots of different, there are a lot of different trades that would qualify you as the first test on a real estate professional. Then you have to actually work in the investments that you own.
And so my understanding of it, and one of the more powerful things, especially if you're a married person and your spouse has a high earned income, if one of the two spouses can qualify as a real estate professional, you can turn your passive losses and active losses and offset the earned income of your spouse. Is that accurate?
That's correct.
Yeah, so it's pretty powerful, especially if you're a real estate syndicator and you get any sort of fee income along the way. Your passive losses to become active and can offset any sort of earned self-employment income that would be normally self-employment income or earned income, I guess. I don't want to misqualify how you calculate it. So that's great. One of the other things that a lot of people talk about, kind of are like repairs and replacement. So kind of what's the difference and how do we categorize what's a replacement and what's a repair and what do you have to capitalize and what can you depreciate? So I don't know if, Mandy, if you want to talk a little bit about that subject matter.
Sure. Why do we like repairs over replacement? Because repairs, we can write them off when we spend the money and take that tax deduction now. And so then what is a repair? It's a recurring activity such as inspection or cleaning, testing, replacing parts in the real estate environment, painting would be considered a repair. And it's anything that you do to keep the property in its ordinarily operating condition. And you would expect to perform this activity more than once during the property's life. So it would be kind of an ongoing routine maintenance or repair. So then again, if it is considered a repair, you can expense it when the cost is incurred. Otherwise, you get into replacement or where you would have to capitalize the cost of the property, which means you set it up on a depreciation schedule and you depreciate it over the life of the property. So again, you would get, let's say it's 5-year property, you would get the deduction over 5 years rather than in the current year. So what types of activity would require you to capitalize? That's if you better the property, such as make a material addition. You add on a room to a rental property, that would be a betterment. A restoration of the property. Let's say it's a truck, the engine goes out, you replace the engine you've restored the property to its full working condition and expect to have an extended life of that property again, or an adaptation of the property. Just being in Texas, I thought this was an interesting example I came across. So you have a fishing boat and you're in the fishing business, and all of a sudden you decide, well, I don't want to have a fishing boat and be in the fishing business anymore. I want to modify my boat and take people sightseeing. So then the cost that you incur to modify that boat would be capitalized rather than expensed. The cool thing is, though, I think effective January 1, 2016, the IRS allowed for a de minimis safe harbor election, which means if you, without audited financial statements, you can expense up to $2,500 per invoice or per item and expense that in the current year.
So anything, so an apartment complex where you replace the appliance package and it's less than $2,500, you can write it off. You don't have to capitalize it, even if you're improving the asset.
Correct.
Yeah, that's great.
Yes, and with audited financial statements, that figure goes up to $5,000.
Okay, cool.
Mike, put your banker's hat on. What really does that mean when we underwrite these deals? Trying to figure out the income minus the expenses equals the NOI. Where does replacement reserves and where's CapEx come in? And do you have to put CapEx above the line? Does that reduce your loan proceeds?
Yeah, typically that's below the NOI line, so you get the benefit of higher loan proceeds because you have a higher debt coverage test. So usually it doesn't impact your loan sizing if it's an improvement to the asset from a banker's perspective, but from a taxation perspective, you can write it off in the current year and save on your income tax and get more losses. I think one of the other things that people miss is if you can do it as a repair versus an improvement and capitalize it, you have to do depreciation recapture in the future when you sell the asset. So if you can expense it, you don't have to recapture that in the future, and it'll save you some future income. So generally speaking, it's best to try to get as much into repairs as you possibly can, right?
Correct, yes.
Yeah. Cool. So one of the things we do that I think is maybe not quite fully realized in the industry, especially if you're kind of new into it, is we tend to do cost segregation studies when we do our properties. So Mark, maybe you talk about what a cost segregation study is and kind of walk through that kind of high level.
So a cost segregation study is actually a really great tool, and we highly recommend our real estate investors when they're considering a purchase and even retroactively thinking about having a cost segregation study performed. So basically it's an engineering study or analysis which attempts to, without getting too technical, it attempts to separate real property from personal property in a given real estate investment. And the impact of that is it will take those different assets and put them in different depreciation buckets. And the objective is to try to put as many assets into shorter depreciation buckets, which in effect generates more depreciation and it lowers taxable income. So the name of the game is to use this cost segregation study to basically reduce taxable income. So it gets into depreciation. So rental real estate typically has a 27.5-year life. And what a cost segregation study does, say for an apartment complex, it will try to identify personal property like wall covering, carpets, electrical systems, sidewalks, things that are not considered per the tax code real property, and push those into shorter depreciation lives. So it'll take a chunk of the total investment and push that cost investment into, say, 5 and 10-year live property, and then the rest will be 27.5-year.
All right, Mike, in English, what does that mean?
You save taxes today. So you bring future depreciation forward and you lower your tax bill today and today's dollars, and then any losses, if you're a real estate professional, my understanding is you could take that depreciation, offset other earned income, and or if you're not a real estate professional, it's passive income, you take it up to the amount of passive income you have to offset, and then carry any losses forward for future years. And is there any expiration on the loss carry forward? You can carry that for perpetuity?
Yes.
Right. Yes. Okay.
Or until the asset's sold.
Until the asset's sold, and then you trigger depreciation recapture, and then any sort of loss carry forward offsets the depreciation recapture or capital gain in the future? Without being too technical?
Yes.
Yes.
Correct. Okay,
yes.
got it.
All right, Mandy, I've asked Mike to explain that in English. Now, if you can have explained what Mike said in English. So I just want to make sure that I understand it. If you don't do a cost segregation study, you're going to get the 27.5% depreciation piece.
Correct.
And so, an apartment building is a sum of different parts, whether it is windows or it is doors or whether it is a roof. If you don't do it, you get the straight 27.5. But if you put it in these buckets and you try to do 10 years or 15 years, you can depreciate these pieces of the real estate even faster.
That's right. And if you think of it in your banker's hat, the tax savings that you receive now is basically the present value of those tax savings that you have today is greater than the future value.
Okay, and then Mike, who does cost segregation? Who should do cost segregation, and what does it cost?
It's a professional engineering company. They have to, I don't know if they're certified or not, but they have to have a professional engineering study that breaks down the components of the building. There's multiple companies out there that do it. I'm sure Mark and Mandy probably could recommend somebody if they want to reach out to them. We use O'Connor out of Houston to do our reports, and then it's about $4,000 or $5,000. Sometimes maybe a little bit more depending on the complexity of the deal. But I think we pay about approximately $5,000 if my memory serves a year to get a study done, and that's good for the life of the asset as well. Correct.
Right, and typically the cost seg engineering firm would do an analysis up front for free. They would do an on-top evaluation of the property and determine if there's a cost benefit to doing the study versus the tax savings.
Yeah, it's pretty much a no-brainer, though.
You do it at the beginning when you buy the property. When do you typically?
Typically do it at the end of the year. Everything we bought that year, we'll just get in lump sum. Go get cost segs done the first year of ownership when we do assets. Like Mark said, I think some people do it retroactively as well.
We'll pick up clients and we'll ask them, have you done a cost seg on your real estate investments? And if not, we can point them to a firm. They can do a cost benefit analysis, whether it makes sense to do a cost seg study. We'll restate the depreciation, amend the returns, results in a tax refund possibly. So you definitely can go backward.
Yeah, and then one of the things that we did this year on our tax returns was new to me that is something called abandonment as well. So as along with the cost seg study, you can determine the remaining useful life of your existing personal property on your real estate investment. So maybe you can, in a layman's terms, describe what abandonment is, Mandy?
Sure, and that's one of the great things that does shake out from a cost seg study is, say you have an apartment building and based on that cost seg study, what you spent, what's carved out for the appliances, your dishwashers, your refrigerators, things of that nature. And that you want to upgrade that property. So at that point, we can pull the old property off and basically abandon it. And whatever costs we have in it that we haven't depreciated yet, we can take as a loss on the tax return. And then you pick up that new property and depreciate it over the 5 years. Abandonment is anything that you voluntarily and permanently give up and you don't intend to pass it on to another owner.
So meaning that you go in as an apartment owner, change out your flooring, your light fixtures, your appliance package, as long as you track the number of appliance packages, a number of flooring units that you've changed out the flooring on, you take that remaining depreciation on the schedule, and then you can immediately expense it that year. It's called abandonment.
Correct.
Yeah. So it really further accelerates the losses. It's a non-cash expense, so it's pretty powerful in my experience. So, and that kind of leads to one of the next things a lot of people do when we have all this depreciation, all these abandonment, and you have a big taxable loss, and you go try to sell your property, you can have a large capital gain because your taxable basis has been, managed to be pretty low. At that point, people do 1031 exchanges. So maybe kind of talk about kind of 1031 101, I guess, Mark, and kind of walk through that for people.
So I'd preface this as a very complicated tax area and one where taxpayers really need experts to guide them through, because there are lots of ways to not do this correctly. But to Mike's point, there's very powerful tax benefits from a 1031 like kind exchange, which basically allows a taxpayer to sell a property, call it the first property, and then reinvest the proceeds into a second property and then defer all of the capital gain. So basically, it kicks the can down the road in terms of capital gain. And this could be a great tool for different purposes. So, for example, understand listeners are all over the country, and if there are any listeners with a certain geographic concentration of properties, it allows them to basically sell and diversify without having a taxable liquidation. And then it also allows someone to lever up a property. So if you have a property with lots of equity in it, it allows you to sell it, take those proceeds, and reinvest in a larger property and put leverage on it. There's a bunch of rules related to 1031 exchange. Probably the biggest one is that the proceeds of the exchange need to be handled through an intermediary. So the taxpayers, as soon as the taxpayer touches the proceeds, it's considered a taxable event. So you need a team of people to help you with this, but it's a great planning tool.
Mike, tell us a little bit about your high level things of exchanges, because exchanges are just not for real estate. I mean, someone sells an airplane that has a huge capital gain, they want to buy another airplane, or somebody has a piece of art, they want to buy another piece of art. I mean, it's the 1031 piece is part of the tax code, just like 401k, part of the tax code. So people have used this for years and years and years, but talk a little bit about, how long they have to designate a property.
I don't know much about art, but yeah, you do need, I think you have a total of 180 days to complete the exchange, and you have to identify the replacement property or multiple properties that you, I think up to 3 or up to, was it 2 times the sales cost or something? Anyways, basically up to 3 properties, you have 45 days to identify with your 1031 intermediary or accommodator to make sure that you are compliant with the rules. And that's just some of the basic rules. And you have to also buy a property that's equal to or greater than the value of the property that you relinquished, as well as have as much or more debt than what you paid off. And those are kind of the basic high-level things. And like Mark said, there's a lot of nuances and rules to it. So make sure you both have a CPA and maybe even a tax lawyer to walk through the complexity of it.
Yeah, and that's what we see is quite a bit of people from California selling properties out in California and exchanging over to buy properties in Texas or Indianapolis or Chicago, some places that are a little bit less expensive to buy property, so you can get a bigger bang for your buck when you do an exchange.
Yeah, definitely. So maybe kind of moving forward a little bit. Entities, so specifically for real estate investors and maybe even specifically for syndications, is there any sort of entity selection that you guys typically see or that you recommend that is better from a taxation standpoint than the others?
So this is a common theme throughout this discussion. There are a lot of complexities with entity selection, but it's a conversation we have with almost every one of our clients. We tend to look at entity selection through a prism of 3 things. One is tax efficiency. So does the structure and entity selection that has been put in place, does that generate tax efficiency? And then there's other corollary things like asset protection. So does the entity provide asset protection, which is where you need a lawyer to assist? And then third, is it administratively easy to operate? So rather than having a very complex, Russian doll of stacking entities, does the entity basically is easy to operate? So you don't have 20 bank accounts and tax returns and things like that. So for real estate investors, it really kind of depends what the entity is doing. So if the entity is holding assets, we typically see those assets held in an LLC. And an LLC taxes a partnership. So the entity can have different tax treatments. So it could be an LLC that elects to be taxed as an S corp, or an LLC that by default is taxed as a partnership. And those 2 treatments generate different tax benefits and consequences. So again, all these things are pretty complicated. So if you have an operating company, let's say you generate management fees, typically an LLC taxed as an S corp is better because it allows the owners to pay themselves and potentially reduces payroll taxes, versus an entity that just holds the assets. That's typically better because it provides for the partners can move the assets around easily without triggering taxable gains. So something Mandy and I do with every deal and every transaction and every new client is we look at the tax structure and evaluate the tax consequences. And and come up with tax benefits.
Mike, how come people just don't put in their individual names?
Well, I would think that's suicidal if you own an apartment complex is in your name and you have 200 tenants angry at you. So,
but I've seen it.
Yeah, that's nuts. So yeah, liability one, and then I don't know if it's the most tax efficient. Mark and Mandy talked to that a little bit more, but you don't get some of the tax efficiencies if you hold it in your individual name.
And then Fannie Mae does not want you to have it in your
and you need to have it in a single purpose entity for your lender. Most likely, they won't give you a loan if it's in your name.
That's right.
Most likely, especially an agency loan, it's a requirement per se. They want to make sure that it's its own silo, and if something goes wrong, doesn't take down the entire empire. Then maybe kind of moving forward a little bit too. So maybe what are some practical tips on how to work with a tax professional? What are some basic documentation things that make you more effective and kind of save time when you're working with your tax professional? Any tips like that?
Sure. Be proactive and work with your tax advisor on the front end. Many times I've had clients come in and say, I sold this property. I have this huge gain. I want to do a 1031 exchange. And it's like, game over. You can't do it. So just planning. We're here to help you. And personally, I treat my clients' tax returns as if they're my own, and I don't want to pay any more tax than I have to. So just be proactive, talk to your tax advisor in advance. It will help you make an informed decision and hopefully help to lower the tax consequences of whatever decision you do make.
So CPAs tend to be very good business advisors, and they see a lot of transactions. So the CPAs tend to be very comfortable with buying and selling businesses and properties and other assets. So, to the extent we always encourage our clients to call us as they're contemplating certain deals. We'll help them think through the tax consequences, financial consequences, economic consequences, and so forth.
Besides what Mandy said about doing an exchange at the end of the year, what do you see for tax reform? I mean, we're 100 plus 120 days with Trump. Have talked about trying to change the rules like they did in '86. What's your personal opinion about that?
So we are on the receiving end of lots of information every day from our various publications and lobbying groups and things like that. It's very difficult / impossible to handicap a legislative process. After Trump was elected and before Trump was elected, actually, we took a look at his tax platform. And it's pretty interesting. It's also, I'd recommend looking at, if anybody's interested, looking at the House tax reform plan, which is also interesting. But handicapping when and whether that's going to occur is pretty difficult for us. So
everybody wants to be maybe a little Trump, not so much the politics, but a little bit of the developer. So, I mean, my personal opinion is I don't think it's going to pass anytime soon. I mean, I think it's, like you said, it's hugely complex. Too many people with their hands out trying to figure out what it's going to do, and I just don't think it's going to pass. Mike, anything else?
No, I mean, I think that's one of the main reasons why I really got, actually almost probably the primary reason why I started doing real estate was one day I filed my tax return and I couldn't even itemize, so I got real upset because I was paying too much in tax. So I went out and did something about it. So I think really if you want to be more tax efficient, having some form of a operating business and or being a real estate investor is two of the easier ways to save on taxes. And, I can't remember who I heard this from, but, if you think about it, the tax code is kind of just a series of incentives. So if you just kind of follow it and do what the government wants you to do, then you can save on tax and really kind of be pretty efficient. So, I mean, we use Mark and Mandy for our taxes personally, and Paul joined them this year too. So done a good job for us. And I'd certainly recommend anyone, if they want to reach out to you guys, what would be kind of the best way to reach you guys and connect with you?
Just reach out to us and give us a call at our office.
What's your email address?
It's Patten, M as in Mark, Patten, Patten at mckcpas.com. And our phone number is 214-696-1922.
Perfect. Well, Paul, any more questions?
Nothing. I think we very much appreciate you guys being in. This is we've said in the beginning, this is a hugely complex area, and there's reasons why people buy real estate, and it's just not just to get a rate of return on their money. Not only are they buying a hard asset, but there has to be some economic reasons. I think we've kind of handled some of the things in terms of depreciation, cost segregation, some 1031 information to that. But again, that's not the only reasons. And so Mike and I are not CPAs. We wanted to bring in some people that were CPAs, kind of let them kind of explain some of the just the technical things. But again, we encourage you to call Mark or Mandy a little bit about what and have them talk a little bit about. Again, they're based in Dallas. But I'm sure that there's questions that, federal questions that you could answer for anybody that wanted to have a question answered too. So we appreciate that. Mike, anything coming up with Old Capital?
Let's see. What do we have? October 5th, we have an event coming up, Paul. So maybe tell a little bit about that.
Not yet. That's going to probably come out in the next week or two, and we'll talk a little bit more about the October 5th conference. Darn, I shouldn't have even said that. October 5th conference at the Addison Convention Center. We'll talk a little bit more about that. It's about a 7-8-hour conference on multifamily, not just lending. That's hardly has anything, but talks a little bit about multifamily brokers, multifamily management companies. And we really focus on B and C properties, not just in the state of Texas, but a lot of the states in and around the Southwest. We'll talk a little bit more about that. But that conference, that will be a great conference to learn about what's going on in multifamily and the B and C. Anything else?
If anyone appreciates this, certainly go to oldcapitalpodcast.com. You can sign up for the white paper, the Multifamily Finance 101, and the sample due diligence checklist. And, of course, we always appreciate a rating and review on iTunes or Stitcher.
Mandy, Mark, thanks for spending some time in the podcast. We do appreciate that. Again, if you guys have any questions, give them a call. They're great CPAs to talk and work with. Again, I'm Paul Peebles, Michael Becker. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.